So welcome to this video. In this video, we are going to look at the introduction to journal, ledger, trial balance, SOPL and SOFP. So first we'll have a basic understanding about what these uh, things are, and then we'll see how to create a problem or how to approach a numerical problem based upon our understanding. So we'll start from accounting cycle. So the first step in accounting is to first identify a transaction. So there should be an evidence based upon which a journal entry is created, after which it is posted to a ledger. Thereafter it goes to trial balance. From trial balance it moves on to statement of profit and loss account, and from there to statement of financial position. So this is the accounting cycle. So we'll start from what is a journal. Journal is the book of original entry in which business transactions are recorded in chronological order, that is like date wise, that is in the order of occurrence. So as and when evidence is created for a transaction, it is like recorded in the journal. Transactions are recorded for the first time in the journal. Entries are made in the journal based on source documents. So only when there's an evidence we could create a journal entry. Record of business transactions in the journal is known as journal entry. The process of recording the transaction in journal is called as journalizing. So this is the format for a journal. You have the date, and you have the column called particulars. LF refers to ledger folio or the ledger number in which it has to be moving. Then debit and credit. So we have the account number, the account name. Okay, so it's like cash account to bank account, like that. And usually we put the word debtor so that this refers to this first item is a debit. It has to be debited. It means the second item here it is credited. Okay, so usually there's a word there's a word to. Okay, so any items before the two are debit items. Any items after the two are credit items. Okay, then you write some narration. Narration is like what is this transaction is about. Is it a cash sales? Is it a credit sales? Okay, to whom it is being sold, like that. Okay, so that's about how we create a journal entry. So this is a typical journal entry. So we have the date, okay, in chronological order, and we have the entries. So cash account, debtor to capital account. Being business started with cash, 5 lakhs and 5 lakhs. Okay, so you have to put once here and another one here, like that. For every record, okay, we have to create a journal entry. There can also be like combined entries like this. Okay, you can also show it as a separate entry or a combined entry. Okay, but we'll see these as and when we keep progressing. So what is a ledger account? So once you have like created a journal, okay, journal is like keep on going for a month. Okay, we keep on recording it on a month basis. On a month, at the end of the month, okay, if we ask us what is the total cash that this company has received, okay, in the month of January, it's like very difficult to find out from journal. Okay, see, look at here, there's a cash here, there's a cash inflow here, and again there's a cash inflow. Okay, so counting each and everything every time becomes so difficult. Okay, so what we do is we create an account called as ledger account. So a ledger account is a summary statement of all the transactions relating to a person or an asset or a liability or an expense or an income. It can be of any nature which has taken place during a given period of time. So something like in a month, what is the cash balance? In a month, what is the bank balance? If you want to know, you can easily refer to the ledger. Okay, so any entry which is posted on the journal, okay, monthly, they will be like transferred to the ledger. Okay, see, manually when we are doing it, it was like translated on a monthly basis, but now as it's computerized, when the journal is created, the ledger is automatically updated. Okay, from the transactions recorded in the journal, the ledger account is prepared. It is a book which contains all sets of accounts, namely personal, real and nominal accounts. Account-wise balance can be determined from the ledger. So you can easily see what's your cash balance, bank balance, You can see what is the total sales, what is the total credit sales, everything you can see very quickly and easily. So what's the use of ledger? Quick information about a particular account, control over the business transactions. Based upon ledger, okay, we create the trial balance, and trial balance helps us to prepare the financial statements. So this is a ledger format. So you have to put a debit on the left side and credit on the right side. The name of the ledger account. We divide the ledger into half like this. Okay. So this part is the debit part and this part is the credit part. Okay. So again you have date, particulars, the journal folio. So JF is journal folio. On journal you had ledger folio. Similar to that you have journal folio. That is from which journal entry this particular entry has been created. So JF is the amount is usually written. So this is about the actual accounts. So you could look here. We have capital accounts, we have bank account, and we have purchase account. If you look at here, you can easily find out what is the total cash balance of this. What is the total capital balance of this company? The total capital balance on July 1st is 2 lakhs. It's so easy and quick. If you want to find out what's the bank balance, okay, of this company on on 1st July, it's very simple. It's 50,000. You don't need to go and search for each and individual entry in your journal. Okay, it's like so quick. You can easily find out what's your balance. Okay, so that's the power of ledger here. So once you have created ledgers, okay, and ledgers are like several ledgers you have to be creating, okay, because for each and every item you usually create a ledger. So once ledgers have been prepared, then it moves on to trial balance. Trial balance is a statement containing the debit and credit balances of all ledger accounts on a particular date. Okay, so on a particular date, something like year end, what is the total ledger balances, okay, that we have are all taken into account, and they are arranged in debit and credit columns side by side, and they are like shown. So we'll see the trial balance here. So this is a trial balance. Okay, so if you see here, it has a serial number, particulars, ledger folio, what is the ledger number, debit and credit. So you have all these items. Okay, mostly these items seems to be assets and expenses. So all of them will usually have debit balance only. Why they have debit balance we'll see later. And here you could see from sales onwards there are like incomes and liabilities. So these items are usually credit items. Okay, so fairly both should be equal. The debit and credit should be equal, because every time we created a journal entry there was a debit and a credit item. Okay, both was like equal. So if each and debit and credit was properly equal, then the trial balance will also be equal, because your journal moved to ledger, your ledger is moving to trial balance. Okay, so why are we doing trial balance? The fundamental principle of double entry system of bookkeeping is that every debit has a corresponding and equal credit, and vice versa. Therefore, the total of the debit balance must be equal to the total of the credit balance. Both should be tallying. When such an arrangement between the total of all debit balance and all credit balance takes place, it offers an immediate and apparent proof of the arithmetical accuracy of bookkeeping on a particular day. So at the year end, when we are trying to prepare a trial balance, okay, and if all the numbers are like exactly tallying, it means arithmetically we have done things properly. Okay, but we can't take that as a exact proof, because at the same time it should not be taken as a conclusive proof of arithmetical accuracy. Okay, as certain errors such as error of principle or compensating errors and complete omission of a transaction are not disclosed by trial balance. So you can have an idea like this. We'll see one by one. What is an error of principle? Okay, so you have bought a machine for 1 lakh. Okay, you have bought a machine for 1 lakh. Okay, but you have wrongly created an entry saying that you have sold the machine for 1 lakh. Will the trial balance tally? The trial balance will tally because there's a 1 lakh debit and there's a 1 lakh credit. It will still tally. Okay, it will not show you any problem at all. Okay, because the 1 lakh number is perfect. There can be compensating errors. Okay, there can be compensating errors. For example, uh, you have without a journal, without the evidence, you have created a sales of 10,000 rupees. Okay, without an evidence you have created a sales of 10,000 rupees. Okay, and wrongly, okay, or wrongly or without evidence you have created another entry of sales returns of same 10,000 rupees. So now both will compensate each other. Okay, the both will compensate each other. So what happens is, trial balance cannot check this and all. What trial balance can check is numerically is it like accurate, it can check, but it cannot give a 100% proof all things are correct. Okay, for example, if you have omitted a particular transaction, there is no debit and there is no credit of an item, right? So it's zero debit, zero credit. So in that case it will still tally. Okay, it will still tally. So these cannot be identified by trial balance. Okay, so trial balance is an approximate way of finding out arithmetical accuracy, but you should not like believe in trial balance itself. Okay, fully we should not rely on it. And it's not necessary that you have to work out the problem. Okay, like first all debit comes and then all credit comes. Okay, it can be like jumbled also. You can have certain asset numbers, certain liability numbers, certain expense. It can be jumbled. Okay, wherever you have a particular item, if it's debit item, you put it on debit column. If it's a credit item, put it on the credit column. Okay, so that's about the trial balance here. We have seen SOPL already. So SOPL is prepared based upon the trial balance numbers. Okay, so from where did we get the sales number? Okay, from where did we get the expense number? So all these numbers are like coming from trial balance. See, we get the sales number from here, we'll get purchase returns number from here, we get we get purchase number from here. Okay, rent paid from here. So all the numbers which are available in SOPL are coming from trial balance, which is coming from ledger. Okay, so SOPL indicates the various revenue and expenses which are generated by the business within a year or operating cycle. So it records all the direct and indirect revenues, direct and indirect expenses. So finally, it will show you the gross profit or loss, operating profit or loss, and also net profit or net loss. So that is the final balance. So SOPL is used by various stakeholders to decide whether the company is making good profit or not. So this should be your SOPL statement. Okay, so it starts from revenue, then cost of sales is deducted, gross profit, deduct all these expenses, you get profit from operations or operating profit, investment income you add it, finance cost you deduct it, profit before tax is there, tax you deduct, you get net profit for the period. Okay, so this is the format for a SOPL. So what is SOFP? Again, SOFP is prepared from majority of the data comes from trial balance. The only data that comes from SOPL is the net profit or net loss number. Okay, so there are some adjustments if there are any. Okay, that will be affecting both SOPL and SOFP. Okay, so what is an adjustment we will see later. It is a statement showing the balance of assets and liabilities as the final step in the accounting process. It is prepared on a particular date, normally on the last day of accounting period. The closing balance of an accounting year are taken as the opening balances for the next year. Okay, so the closing stock of this year is the opening stock of the next year. The results are communicated to the users of accounting information for the purpose of analysis and decision making. So SOFP is a very powerful statement based upon which several decisions are taken. Okay, so this is a format. So this is a format we'll also be using. So it starts from non-current assets, property, plant, investment, intangible, current assets, like that. It keeps moving. So this is exactly the format that we'll be using in our problems. So thank you very much for watching this video. we will look at how these statements are used within the problem.